Here's something nobody tells you about growing a contracting business. The faster you grow, the more cash you burn before you ever get paid. It's called the working capital gap, and it has killed more good businesses than bad markets, bad customers, or bad luck ever have. That's what we're discussing today on education.
Welcome back to education. Imagine you just won the biggest contractor company's ever seen, a $3 million data center build out. The team's ready. You have the reputation that got you through the door, and you're about to run out of money. And that's kind of what we're here to talk about today. You find yourself in this sort of situation because mobilization costs are due day one. You have equipment procurement, which is day maybe 3 or 4, or week 3 or 4, and then your labor you have to pay out every other week or every 2 weeks. And the client's first draw, well, that's not really until day 90. It could even be day 120. What causes the working capital crisis of scale is something that we're going to be discussing today. And I think it's really important to discuss it because without a solution, you can really get yourself into a pretty bad bind and find yourself short on some cash. And we wanted to discuss this so you can figure out how to solve this without, giving up some sort of equity and what every specialty contractor needs to have in place before a big event or a big project or something that you may have coming down the line.
Yeah, and growth is something we talk a lot about, on our podcasts and the businesses we talk to, and it's always great to get a really large contract ordered to you, something that might be a huge step up in terms of relative to the contracts you're accustomed to getting, but you know broadly, I mean, we're going to be talking about contractors today, but this is going to be a good show for anybody dealing with a potentially unexpected amount of growth. I mean, we talk to companies and some of the people we work with. you know Growth is typically what one of the biggest objectives is. Objectives it excuse me. Growth is one of the biggest objectives for some of the smaller businesses. Obviously, if you're a company that's doing 5, 10, 20 million revenue, there's still going to be a long runway of growth ahead of you, and you're not really at a point in your company where you're looking at cutting cost per se as a way of growing your EBITDA. But the counter to that is as you make these incremental you know steps towards your growth, especially in something that's in a contracted space where you're typically, you may be dealing with $1 million contracts, a couple $1 million contracts. Now all of a sudden you jump and you get an offer for a $10 million contract, and it's, you don't want to not turn that down because it's obviously going to be, highly meaningful to the company, but you're, in a position of really stretching yourself out cash wise unless you're properly prepared for it. And so that's really what we're going to be getting into on today's show is, navigating that environment, making sure you're set up to succeed, and what are some of the financial tools available to you to help ensure that that's a smooth transition and a successful transition into kind of these larger contracts that you may not typically be accustomed to. So leading up, one of the deals we're going to highlight right now is Ambient Enterprises and their acquisition of Integ. And just for you aware, so the Ambient is a data center contractor.
Yeah, they're really a national HVAC design and implementation platform. This deal was actually announced in 2026, so earlier this past year. They have over 1,200 employees. They actually had to raise $872 million for this. But Integ Systems, which is who Ambient purchased, was founded in 1996. It was a specialized provider of mission critical power and electrical infrastructure, UPS systems, diesel generators, gear or switch gears, power distribution, battery solutions, and long time service contracts. So you can kind of see the importance of why Ambient did purchase them. So it was something that could be added on to their business, especially when you're in this sort of HVAC electrical space. One goes kind of well with the other, similar to like peanut butter and jelly. But Ambient really purchased Integ because they needed to add power and electrical infrastructure capabilities alongside their HVAC. So this allows them to kind of create a full system integration. And what they were able to target then was these data centers. And as we all know, data centers have been a fairly controversial topic currently, but it's something, unfortunately, that we're all going to have to use, and we currently do use. But um, the data center markets, the two biggest things that people look for, water and the power that's done, or, power. Obviously, the more power you use, the hotter things get. So you need also a cooling factor for this. This could be done with water, it could be done with air. But point being, there's a lot of HVAC, thermal and power demands that are needed for this. So Ambient was actually able to purchase Integ to then go after this sort of market, along with other sort of items. So that was the main thing. So there is a little bit of a recurring revenue angle here. Integ's maintenance and service contracts delivered a pretty steady recurring revenue, which is exactly what this profile really wants, and that a lot of people really like, and you get a lot of premiums from this. But mission critical clients, which we call sort of like these data centers where you're so heavily reliant on two things, they don't really switch providers because it's too hard to kind of go back and undo everything, because the longer these data centers are down, or think of it even as like a nuclear power plant, the moment they shut down the power plant to add new fueling rods, it's just money being kind of thrown out the door, because it's not days that they're up and running, so to speak. So it's the same goes with data centers. So it's a very sticky industry. They usually like to keep whoever they have on staff for a long time. You can create a lot of contracts with them, because once you're in there, it's kind of hard to switch. There is a comparable that we have for the visual audience. It's actually up on the screen here. It's the Dicon comparable. Dicom acquired Power Solutions Data Center Electrical for $1.95 billion in November of 2025, and they were $1 billion in revenue. They had about 2,800 employees, and this is once again a sort of category or area where a lot of things are heavily being looked and sought after to be acquired. The LBC credit facility, Ambient actually raised a senior secured ABL from LBC Credit Partners in 2024 to fund acquisition and growth. The facility actually uses a similar tool, and a lot of contractors and other similar businesses use the same thing. I don't know if you have anything to say about ABLs, or if you want to jump into that at all. If
Yeah,
not, we can move forward.
yeah, I think going into the next slide, we'll talk about that briefly, or you'll go over some of the options. But just to kind of get that transition into that. So for the operators in the audience, this particular acquisition solves a few handful of problems. Gets them that operational infrastructure. Were they able to the systems, reporting, recurring service contracts, and secondly, Christian just brought up the ABL financing. So, that's going to be a component that you can use to really help bridge that growth and make sure you have the cash available to meet, the project deadlines and the milestones you need to hit, in these contracts, and do so in a way that keeps your cash preserved, and allow you to make that transition to service that big contract, and really help bridge that growth that you obviously need, because ultimately, everything kind of boils down to a funding issue, and it just really how you manage your cash, and what tools you're utilizing to really help again bridge that gap from that $500,000 contract to a $3 million one, or a $1 million contract to a $5 million one. These big leaps forward that are obviously could provide an incredible value to your company, really help you take that next step into that next stratosphere of companies you're operating in and alongside with. So something you don't want to take for granted. You want to make sure that you're well prepared and have thought about some of these tools at your disposal, financially speaking, to make sure that you're not make sure that you're capable and in a position to take on these contracts, because obviously it's something you don't want to that's too much value on the table that you could potentially be leaving. So
Yeah, the contractors who can't fund large contracts are the ones that are usually going to stay stagnant or within their area. But those that can kind of figure out how to finance this and actually win these contracts, those are the ones that tend to usually grow and become the platform that a lot of these larger organizations are looking to do. Because once again, in our previous episodes, we're looking for kind of repeatability, recurring revenue, items that are pretty stable and easy to attach other businesses onto, just like this ambient acquisition of Integ.
yeah, and ultimately, and uh, just to get into the issue again, if within your contracting business, if a customer offered you a contract that was 3 times the size of your existing contracts, how capable would you be of jumping on that? I've kind of threw out 500,000 to a million, or 1 million to 5 million. Yeah, think of the largest contract that you have currently, and you got an offer and an opportunity to take on a contract 3 times that size. How ready are you to take that leap? And if you think it'd be too much to handle, and a large component of that could potentially be how you would manage cash during that time, this is obviously going to be an important segment for you. Secondly, do you have a credit facility, and is it really just handling the current customer base and contract base that you have now? And have you talked with your banker? Have you know run through these scenarios where if you this type of opportunity did come up that could grow the size of my company by 50% even, how well positioned would you be to be able to handle a contract like that? So if you already have a credit facility, a lot of customer or a lot of listeners might for their existing business, but it might be worth having that type of conversation with your existing lender, um, as far as what are some tools that might be available to me should an opportunity like this arise. Easy 30-minute discussion with your lender. It doesn't have to be tomorrow, but you might have quarterly check-ins with them where they talk to you. It might be something to bring up in your next conversation with them. um,
Yeah,
and then
this is definitely stuff you don't want to whiff because or kind of wing it, so to speak, because the last thing you ever want to do is hurt your reputation because it could prevent you from staying within that realm.
yeah, and, you want to be able to take those opportunities when they arise. And the last thing, like Christian had said, you get an offer for a contract, but then all of a sudden you turned it down because it was something you knew you couldn't handle. You weren't didn't you have the right preparation to have going into it, and then you may not get that phone call again because word goes around. It's like, oh, this company can't handle these types of contracts, um, and so you may potentially lose them. So obviously you don't want to rush into anything, but that's why this episode is here, because we want to make sure that you have the right tools, um, to be able to go into those conversations and those potential discussions in a way where you can take on those contracts with a level of confidence that it's not going to overstrain your existing operations.
Yeah, we'll actually go into these tools that we were talking about. We have three. Once again, they are on the slide, which you can view on YouTube. But the first one is AVL or ABL revolving credit. The second one is purchase order financing. The third one is unitranche private credit. So you want to start with the first one, and we can maybe. I think this would be the one that a lot of people would pretty much look to to use?
Yeah, this would certainly be your first avenue. It has a prominent type of working capital financing is really just using your receivables and in many cases your inventory too as a way to get that financing that you need to help bridge that gap. So maybe I know we're talking about contracting, but if you're if you have a lot of inventory, if you're you sell a particular product and you know you have a lot of purchase orders coming in, and you need to be able to fund that gap between that inventory that you're going to need for that large purchase order, is being able to use that, being able to borrow against that, your purchase order receivables so that you can um, help fund that difference and make sure that that cash is coming in so you can fund those orders and then obviously get that margin that you need. So the in the alternative case, for a contractor is you're getting draws from the contractor, you're able to borrow against that, over a 90 day. It's a short term type of financing, um, 90-day type of cycle. We're kind of just funding that cash gap, and then as you're able to take draws through through these milestones you're hitting in your contract, then you just start paying that down. But in the meantime, you're making sure your payroll is getting made. You're getting the procuring
Materials,
the
yeah.
materials, procuring the equipment you need for that potential construction or whatever it is that it is for that contract, and not being worried about your existing cash position because you're able to borrow against that, and then you just pay it down as you're able to get draws from the contract. And the typical cost is the overnight financing rate, kind of a floating interest rate plus 2 to 3%. Um, so obviously, relative to some of the other alternatives, pretty low rate of financing uh, that gets you from point A to point B. Secondly, we have the purchase order financing. So this is something I kind of had hinted at, but it's its own kind of animal where rather than a third party, traditional working capital line of credit type, bank institution is getting purchase order financing directly from the supplier. So you get purchase orders that come in, um, and the lender ends up paying the supplier directly. So you repay when the client pays you. So on equipment heavy contracts where procurement is the primary cash barrier, and it's typically 2 to 5% off the top of the PO value. But again, it's non-dilutive, so it's you're taking a discount on it, but ultimately it's all about being able to service larger contracts or just service larger purchase orders, and not be fronting out the cash in a way that can be disruptive to your business.
Yeah, the last one is unitranche private credit. I know a lot of people have seen actually a lot of advertisements for this recently. I think what's his face? Grant Cardone does this, right? He sends out these business things. But anywho, pretty much what a unitranche private credit is, it's a single tranche that combines the first and second lien from a private credit lender. And usually, when you have a private credit lender, you are having to put something up as collateral. And for instance, could be equity, which would be a portion of your business. This one I don't really recommend for a lot of people. Uh, it can be a little bit more flexible at times than your stereotypical banks, even your local lenders or credit unions or whoever it may be. Um, these do have higher advance rates. Once again, these are also short-term loans, so you'll typically see these be anywhere from 12 to 16 months at most.
Yeah,
Um,
so a little bit longer term than your revolving credit facility or a purchase order financing. There is unitranche, also an acquisition. So like that's a thing about private credit is it can be highly flexible. You can see um, some of these the term length unitranche can cover kind of that medium, short to medium term, but
Yeah.
it can also be a multi-year type of proposition. But that's, the unique thing about private credit is, they're not, you know, they can, be a little bit flexible on the term length. Obviously, we're talking more about shorter duration type of, bridging of cash flow issues. But, ultimately, if you think of, we call it, mezzanine debt as far as the second lien, and,
Yeah.
your traditional senior debt from, typically a bank. Private credit's they're kind of just blending those two things together into um, one senior piece that's, combining aspects of both, the second lien piece, the mezzanine piece, and the senior debt on top of that. But can be a bridge. Obviously, it's something that, you know, would cover, if you have a contract that's, again, 18 months or whatever, that could be something that's, paid out, from that, where it's, you're kind of matching that, duration with, the length of your contract and taking it that way. But um, yeah, obviously that's kind of tertiary to the first two options. Obviously, it really kind of depends on your your needs and what kind of collateral you have at your availability, and again, also your just willingness of banks to, with purchase order financing. Obviously, you have, um, inventory, that's being tied to these purchase orders that is, asset backed in that degree, as as well as the asset backed um, line of revolving credit, the
Hmm.
ABL. So, for something that might be a little bit more, you have a contract, but it's, it's a largely a service contract, and you may be, procuring equipment, that you're renting to, during this construction cycle, but you not necessarily have collateral outside of, the receivables. And depending on, and for something like a data center, obviously,
Yeah.
these are going to be, highly, um, in the in the views of the contracting world, obviously, like a very stout, customer that, a bank you think would be comfortable, lending for. But obviously, for some of the smaller contractors, where, you know, I don't want to say reputationally, but, there may be a sense where, the bank still isn't comfortable, um, financing against this, contract for whatever reason. Um, Again, reputable isn't the best word, but, obviously, with a data center, obviously we're talking, billion dollar,
Yeah.
um,
Jobs.
financial, financially secured jobs that are, you know, no one's going to be able to, no one, there's not going to be any discomfort about borrowing for that, because there's too many incentives for these data centers to work and these projects to be successful. Um, but for, again, if it's a contract, let's say it's a commercial construction project, and, the bank is worried about the developer, um, maybe they have, credit issues on their end, and, they have some concerns about their ability to pay over the course of the project. And all of a sudden that makes, getting maybe one of the first two options a little bit more difficult. That's where private credit could,
Yeah, that's where you
um,
look to kind of fulfill your needs there. So we are going to move to uh, NWC, which is known as networking capital. This is kind of what we were talking about in the beginning. So on the actual visuals here, we do have a couple of slides for you. First one is, what is the NWC peg, or the new working capital peg? Next one is, why does it hit contractors the hardest? Third one is, how much can it cost? The last one is, how to protect yourself. So
and for the first one, this is kind of a, this is for if you're selling the company. Obviously, you've been talking mostly about growth and funding that growth, but uh, when companies or potential acquirers are looking at your company, and let's say you're kind of in the middle of this potential cycle of a, large contract, and, they're looking at your receivables and, you know the runway you have, with that in terms of your cash position, they're going to be, um, taking that into account of their transaction value, there's actually a company that we're looking at right now that it's an asset purchase, but the asset purchase has a floating amount that's basically the net working capital, and that's what this is kind of talking about here, where if there's if the receivables in excess of liabilities are you know or payables, I should say, if the receivables are in excess, like basically we're on the hook for any receivables in excess of payables. And when we first were looking at them, they had a very large receivable still pending that was within that 90-day threshold. And we were kind of like, well, we want to see that get paid to you guys first because we don't want to be the ones transacting against that, and then also potentially have some concerns about collecting on that receivable if that were an issue. So that's going to be something that buyers will be looking at if you have a very large your receivable, a very large contract that you haven't fully collected on hanging over the company. And so they'll probably take a look at your historical net working capital and kind of creating that peg, so to speak, and kind of tying the transaction value to that, and either adding or subtracting to the transaction value based on where you're currently sitting on that. So again, if you have a receivable that's really high, that could warrant taking a second look, and a payable as well. I mean, obviously it could go either direction, but it's something you want to be mindful of when you're looking at selling your company.
Yeah, and for the second one on why does it hit contractors the hardest? I mean, thinking about your mid-contract on a large job at close, you have the equipment order, the mobilizations are costs out, and but there's still no payment. So your working capital is temporarily elevated, and that could trigger a clawback. And so to kind of go back to that first portion, the reason why this is kind of set up is, I mean, you're really expected to deliver with whatever working capital was been assigned, like what Steven said, against your receivables, against your payables. But if you actually deliver more, then the buyer would get whatever the excess is as a reduction in price. So we really want to make sure that whenever you're going for these jobs, that you are kind of hitting your targets. Actually, I think this could be applicable to also DoD manufacturers, depending on how big you are. And within that space, they'll usually have certain areas where you are expected to hit X milestone. If you do, then you get X payment, and then if you're at the next deliverable or milestone, then you'll be at Y, so forth and so on. But in order to get to that first two, let's say you'd have to go out and find some sort of capital to push you over to make sure that you could purchase the actual materials needed to do so and actually get the appropriate labor installed. But I'm going to go too far down the DoD track on that. But yeah, the main idea is this can really affect if you're a contractor, and especially if you're building something out and so forth and so on. How much can it cost? On a large contract, our producers did a little bit of background on this, but the NWC judgment can be 500,000 to 2 million plus. Personally, I don't think I've ever seen something smaller than 500,000.
Yeah,
that's usually kind of
or to a point where it'd be meaningful.
Yeah. Most sellers don't see it coming because they never had a deal explained to them at this level in detail. Once again, you're not looking lower than 500,000. If you're struggling at that 500,000 range, I would probably look to see how you can increase your business to get to that 500,000 level. I doubt you'd have trouble, or I think you'd have trouble finding anybody that'd be able to loan you that sort of cash on hand at the moment. How to protect yourself. So you always want to negotiate. First and foremost, always seek counsel from the appropriate professionals, lawyers, accountants, whoever it may be. Once again, everything is negotiable. I feel like a lot of people kind of forget that when it comes to, finance, especially if you've been dealing with a bank and you've done these contracts before with like your local bank. It could be, I don't know, a Truist or whoever it is. They may be a little bit more favorable to you because you have a really good track record to this. So you might be able to ask for, or like a carve out on, some sort of contract specific, uh, WC spike. Another way you could do it is you could look at the time to sale, to avoid closing during heavy mobilization.
Yeah, and the big kind of the biggest example, especially because we are talking about um, being in the middle of a large contract where you imagine, let's say let's say you're a company that does 5 million a year, but you just took on, or yeah, taken on a $2 million contract. Let's say you even finished that contract, but a large portion of that, let's call it even like $1 million, um, hasn't been given to your company yet, and so you're looking at a company that showed 5 million on paper, but they still have 1 million in receivables and still waiting on that money coming in from that large contract. Now all of a sudden, company, you know, but for whatever reason, you're also in the talks to sell your company. Well, now you have this $1 million receivable hanging on the table that could either get clawed back entirely, or either impact the transaction price. That's why it might be easiest just to, again, you want to have it negotiated, because you don't want that that revenue's earned, but there's obviously that big receivable floating out there, that in terms of getting that cash in, you've already declared it because you've already performed the work and you've already earned that revenue, but that revenue hasn't fully shown up into your cash flow statement. So you have this large receivable hanging in the balance. Could easily cause some issue in the negotiation. So you got to make sure that that's properly accounted for, because it's obviously going to be flagged by an acquirer, and making sure you have the right language in there for that. And the simplest thing is, ideally, you get that receivable in. It's part of, comes in as part of the transaction. Now is it's cash within your company, and calculated into your transaction value that way, as opposed to this sticking point that is now having to be negotiated as a net working capital peg, for example. So um, obviously, if you are growing, usually you take one thing or the other, not trying to grow and sell at the same time. But even if you weren't growing, but you're in the middle of a contract like this, it could still end up being a um, kind of a thorn in the negotiation as far as how that gets handled and settled. So you want to make sure that that's um, that receivable is reliably going to get paid, and not have that be an issue. But obviously, before you take on any large contracts and you get that transaction buttoned up, done, and you're on your way. But certainly something to keep in mind, if you're in these types of negotiations, is kind of where am I in my contract cycle? Do I have anything that I've taken on that's really heavy compared to my typical workload? And is that going to be an impact, or be an issue for a potential transaction to get done?
Yeah, I mean, accounts receivables are always good, but cash is king,
Yeah,
right?
cash is king.
So that's the end of the episode. We're happy that you listened. We do have these slides once again on our YouTube channel. If you are interested in speaking to us, please, see us at SEG Edge, or at all of our social media platforms, and segandco.com. Once again, that's segandco.com. So thank you guys for listening.